Hi guys, welcome back. So at first I thought maybe it's holiday coming up, so I should take a break and skip a video. But then I thought, how can I have a good Christmas holiday without wishing you a Merry Christmas, right? So that's why I still make a video today to be with you right before our happy holiday, okay? First, I'll cover a little bit of the market and then I'll share where I see opportunities where the money is moving into. And I'll update on the HSI, the Hong Kong stocks, those Chinese stocks. I will update on NIO and explain because a lot of people are getting nervous or anxious. Why is NIO not following the strong momentum of Tesla and Xiaopeng, right? I'll explain this and then move on to the biggest news of today for Chinese market, which is Tencent giving out dividend with JD shares. And this news make a huge dive in JD stock and I want to share my opinion on that. Let's begin right away. So yesterday I updated on the Discord the resistance of the S&P 500 to be around 4,700, right? And today in the morning, it right away had gapped up above the biggest resistance. Wow, such a strong momentum. So I think the risk for the market is really greatly reduced because of this gap up. But with that said, I do think this correction was a lot about the smart money moving their portfolio, planning for the next year. So they are moving the big capital from the previous hot sector into the less popular sector that were lying down on the floor, right? In the year of 2021, I think the biggest sector should be the FANG, the big tech, chip, and network security. But with this correction, I think the money are moving into the less hot ones, such as the ones in Russell 2000, the second to third tier tech stocks, like many in the ARK ETF, and also some recovery that's in the Dow Jones. You can just see from the index that right now Dow Jones and Russell 2000 are the strongest index, outperforming the Nasdaq. You see, the S&P is near all-time high, while the Nasdaq was still trying to break this downward trend, right? Another one is the UVXY. It had made a new low today, meaning that the index is more risk off for the S&P 500, while the SQQQ has not made a new low yet, but not too far though. Right now it's still getting a support, meaning Nasdaq might have a little bit pullback next week, but maybe not long, not much. For the HSI though, last video I shared with you how similar pattern it is making with the year of 2018, meaning that we might be as well very near the bottom as well. But being the bottom doesn't mean a rally right away because, like I said before, the metaphor with the car driving on the snow, the car does not stop right away easily because it would keep on going even though you put a brake to it. Coming down the whole way, it was quite a fast drop. I think more and more short position were being opened. And it cannot have a real rally until all those short position have turned to the long position. The sure thing is that right now it's not much strength to drop recently already because it is getting so close. And back in September when the HSI was breaking the double bottom at around 25,000, I gave two targets for the index. One is 235 and second target 228. And on Monday, the lowest it got to was 226. So after this whole fall, we are exactly at the target, just 0.5% lower. And this target happened to be testing this long time yellow trend line to be exact, right? I saw it went a little bit out, but able to close above right away, right? So at least that is good. With that said, back in 2018, you can see that even though it had bottom here, that looks very similar with the pattern. Like right now, it doesn't mean a V-shaped recovery because it would spend time to form a good base. So that's why right now, I think if we are really similar with that time, then it is a good time to accumulate a long-term position, but not so great for the short-term swing trade because it might just go up and down. for the stronger stocks and for the weaker ones, it's possible to even make lower lows, right? And I think the tech ETF, the Hang Seng Tech Index, including a lot of the tech and internet companies, I think it might have chance to bottom first before the HSI, because a lot of the correction started with the internet giants such as Alibaba, right? It started to fall since last year in October, earlier than the whole market. So I think the tech index ETF might have chance to bottom before the Hang Seng Index. But again, bottom doesn't mean rally from here or V-shaped recovery. It just means it's a relative bottom that I think it's good to accumulate the long-term position. And it also varies for different sectors. There is no way we can know right now, once the Hong Kong index stabilize, which sector would grow first, right? And in this case, I would suggest to have an alternative choice with the KWEB. So it's the ETF that covers a lot of the China internet giants, right? Like Tencent, Baba, Meituan, JD, Baidu, Pinduoduo, etc. So if we go back to 2018, here, it has a strong correlation with the Hang Seng Index, right? And also it balances out the risk of having only one heavy position in the internet tech giants, like the BAT, for example. We know they have the fundamental to support them, to have a good future, but yet we don't know which one is going to take the next hit by the Chinese government or the regulation or some industry revolution, right? So this is the point for the ETF like KWEB. Just take example of BYD, right? Right now it's the strongest EV stock for the Chinese. And back in 2018, it was also falling quite hard with the whole market. But overall, with every market correction and the COVID crash, it was still making lower lows, even though BYD is such a strong company, right? And backed by Warren Buffett too. So imagine those growth stocks that were not invested by big funds like Warren Buffett. So in this case, maybe KWEB is not a bad choice. The only thing is that it is a little bit mild, while a lot of people want excitement and like the volatility of the growth stocks. Then there is CWEB because it's the 2x of KWEB. So it makes it more ups and downs by bigger leverage. So if the market drop more, but things start to grow, then it will grow much more. So it's a way to lower the risk and have more correlation with the index. And at the same time, the range of movement like growth stocks. Just look at how much it grew from the bottom to the top. Last year, it grew from 17, the lowest, to the highest of 110. So if you catch the right movement, it can easily 5 to 10x. But at the same time, it's risky. So imagine you bought it at the top from 110 all the way, write it down to 11. The lowest on Monday, it's 90% gone. So big risk, big reward. But if you believe that the internet tech giants have a high chance of recovery, and if you strongly believe that next year or 2 years later, they would be much higher than right now, then I think it's good time to accumulate. But because it's leverage ETF, so it does have the cost of the time. So you can see that it has been making historical low. So right now there is no support and resistance to analyze. So I will use the KWEB. For KWEB, right now the support is 37. I hope this support doesn't get broken, because if it does, then the next support would go to around 34 to 35. So I think KWEB is a good choice to balance your portfolio. You can even think about allocating some of your Chinese position to this, because they would have the fund manager to keep changing the position according to the fundamental of the companies, right? And to lower the risk. And you can see the volume for the past few months, it kept going up. The more it dropped, the more volume, the more participation from the big funds. On the US side, I think we see a lot of opportunities here, because you can just look at the Russell 2000. If you remember, the whole time for the past few months, I've said many times that I am bullish on the Russell 2000 to make an all-time high. It did, but then right away came back down because of the Omicron virus, and now it has picked up the momentum again. Last month in November, during the market correction, I have drew out the support. My target was around 210. So if you remember this support, you should be able to catch a good dip. You see, on Monday, it had got to 208 and 210, right? And again, if you think this is too mild, you can also consider the triple leverage for the Russell 2000, which is TNA. You can see just for these few days, it has gone up 20% already, which is not small movement at all. All the big indexes have significantly smaller volume recently with the big jump up, but Russell 2000 had a very good volume and good jump, outperforming the index too. So look at where the smart money is going. The volume cannot lie. Retail investors cannot make this movement. And other than the Russell 2000, the Dow Jones is also running up very strong. Why is that? Well, there's a saying that next year, the COVID will really officially go away. In this case, we should really start looking at more closely the recovery. I've covered airlines before, but also pay attention to cruise line like CCL or RCL. You can see that it has a really good run up with volume too. So do watch out for that. Another one is Uber, because a lot of people like to invest in technology stocks. And Uber enjoys the recovery sector and the growth stocks as well. The whole time it has been falling quite a bit, but recently it seems like it has a nice recovery. So I think if the market has some pullback and can make Uber back test between 40 to 42, might be opportunity. And also Airbnb, because next year we would be hopefully seeing more traveling activity. So in this case, it should be a strong recovery for Airbnb. And you can also take a look at DKNG, DraftKings. If we can get a recovery for real, then their business should be back on track. And recently, ARK Invest had been buying the dip for DKNG, something for you to consider. Now, the biggest news today was the JD.com, because it was 1 or 2 weeks ago, Tencent had announced to give out dividends. So the market took it as a bad news. Why? Because only the companies that stop growing or peak already would give out the dividends, right? So we saw a big sell-off, breaking the 460 resistance that I had been pointing out. But yesterday, it gave out a very surprising news. They said they would give out dividend with JD.com's shares. So Tencent is the biggest shareholder for JD. They own about 17% for the total shares, even though the founder of JD has only 13%. And now Tencent is giving out this share to be the dividends for the shareholders. So with this news, Tencent had a big run up yesterday for 4%, while JD had a big hit of 6.9%. At some point, dropping 10% in the morning and recover a little bit. So there is no doubt that this is a bad news for JD, because it means it would have a lot of the shares outflowing to the market, a lot of supply all at once. Once the shareholders receive the JD shares, I think they are very likely to sell it, because they wanted to invest in Tencent and not necessarily have faith in JD, right? We don't know for sure, but this is something completely new. No one has seen before to give out dividends like this. Other than more supply, it would worry people that if JD lose this biggest investor, does that mean Tencent would give out the support they used to give to JD to be able to compete with Alibaba, right? Does that mean Tencent has lost faith in JD? A lot of people are getting worried. I think the whole point Tencent did this was not because they lost faith in JD, but because it is a response for the CCP's plan on the common prosperity and anti-monopoly. So instead of being the tech giant that owns many businesses across the industry and eventually be broken up because of monopoly, they rather do it themselves. So in this case, it won't be taken as a black swan for Tencent later. And instead of having substantial amounts of ownership in these other big techs, Tencent should really put more efforts into growing or developing smaller companies, smaller tech firms that can shape the future of China for the newer industry like the EV, the new energy, right? So I think that's the whole purpose why they are doing it. So other than not having Tencent as the biggest holder and also having more supply of the shares, nothing much have changed from the company's fundamental for JD. In my opinion, I think the business model for JD is great to focus on building a very well-planned infrastructure with logistic and combining the AI with deliveries, like we talked about before, the robotic or the AI management for the whole logistic and infrastructure, and also shaping the supply chain for the industry of e-commerce. I think over the years they have built enough moat for them to sustain in the fierce competition. I remember the founder of JD once said that Alibaba will for sure one day copy their business model. He said it 2-3 years ago, and I think maybe it's happening. He might be right about that. On top of that, JD is number 6 in the portfolio for ARK ETF. They have it in ARKQ and ARKF, and it's still the biggest Chinese stocks position for them. So it seems like they are still quite bullish on JD out of all the Chinese stocks. Unless they sold a big chunk of shares today, I don't know. Because they did sell some JD shares in December. Maybe they have heard some insider news from Tencent, I don't know. But this morning I have shared on the Discord that I have bought the dip for JD. At that time it was 9% down, looking very scary, and I really don't know if it would keep falling because, well, I think it's never safe to catch the falling knives. And also I think with this news, a lot of short positions have been opened for this, knowing there would be almost 15% of shares releasing out to the market soon. So if you like JD, you can also try to grab the dip slowly because it's impossible to know the bottom, right? And for the dip I bought today, I will set a trailing stop limit in case it dips suddenly so I can still lock in some profit. Last, I think a lot of people are feeling anxious why Tesla has been running up 2 days in a row and Xiaopeng had gone up quite a lot too. Why is baby NIO not following, right? So there is fundamental side, there is technical side. For technical, Tesla and Xiaopeng, the whole time during the correction, it did not drop below the big institutions cost. For Xiaopeng, it was in a range of 35 to 45, right? So really, it was like the one entire year that they have been building position in this range. So in this correction, it did not drop below this range of cost. Makes it much easier to pull up, while NIO had really broken the average cost for the institutions, which is around 30 to 40 that they spent 1 year to build position. And that's why it will take longer to recover. More effort, more capital. Because the moment it runs up, people want to get lost, right? Institutions know that. That's why it usually doesn't go up right away. You can see it from the chip. For Tesla, you see, 68% of the chips are making profit. For Xiaopeng, 51%, more than half still. And for NIO, mostly red, only 20% are making profit. This creates a lot of pressure up there to pull up. But the good news is that today we really had a breakout, at least out of this downtrend. So we can be more risk off for now. Fundamental-wise, a few months ago when I said I think Xiaopeng would grow more than NIO this year, not many people believed it, and now you can see why I said that. Because Xiaopeng had the P7 launch and it was well received by the market. And recently the ARK ETF endorsing Xiaopeng, they kept buying the dip. And I think it's because they acknowledge the autonomous drive, the software they're developing with the AI technology. So this is really good for Xiaopeng. Like I said, their fundamental has been improving throughout this year, especially when you see this comparison. For the 3 from January to October, the blue is NIO falling from the top to the bottom and Xiaopeng growing out past the 3, right? And that was because of the P7 mainly. Looking at this, I think a lot of people would get worrisome and wonder if you should switch from NIO to Xiaopeng now. In this case, you should hold the decision for now because it is still very early. It's normal for them to move up and down, above and below each other. And this year's performance does not mean next year at all, because NIO still doesn't have a sedan. All the sales were driven by the old models which were released a long time ago. So by the time the 87 and 85 are out, it might be very different. And NIO has a different business model, different than anyone, different than Xiaopeng, different than Tesla. So I think they will always get their spot, their position. Once they build up the user habits, the consumer habits, then it becomes their moat, and that would be irreplaceable. So that's why I kept saying NIO needs to speed things up. But I am quite optimistic about the ET5 especially. It's just that right now we won't see it increasing the number significantly. So I think we would need to wait for 2023, next year, to see the real performance of NIO. For now, we just need to be patient. For me, I have all three of them, NIO, Li Auto, and Xiaopeng, and the amount of shares I have is ranking still NIO, Xiaopeng, and then Li. I think it's good to diversify, especially they all have different strategy, so they would have their own market share. So that's it for today. I hope this can ease off your concern. Recently with the market, I have updated you how I see the market, where the money is moving into, what opportunities I see, and for Chinese stocks and the EVs. So hopefully you can have a good holiday with your family and the ones that are most important for you, because we have had a rough year. It is very nerve-wracking and stressful. So hope you can finally have a chance to enjoy more time with your family, and to see that whatever happens, you and your family's health is more important than anything. Now that's it for today, and if you have enjoyed this video, please give me a big like and write me a great comment. And I wish you a Merry Christmas and wonderful holiday, and I'll see you in my next video. That's it guys, hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.